Welcome to the Lend Academy podcast, episode number 38. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I am delighted to welcome Sam Hodges. He is the managing director and co-founder of Funding Circle USA. Now, Funding Circle is really the leading global marketplace for small business loans, and they have been around in the US for a couple of years and based in the UK, and where they started about 5 years ago. So I wanted to get Sam on the show. We actually were together in Washington, D.C., testifying in front of Congress a couple of weeks ago. And I'm going to talk to him a little bit about that, but also just to get an update on Funding Circle. They launched their fractional marketplace a few months ago, and wanted to get some information about that and about their traction they're getting and the returns they're able to produce for investors. Hope you enjoy the show. Welcome to the podcast, Sam.
Thanks for having me on the show.
Okay, so let's just get started with telling everybody a bit of background about yourself.
Good thing. So I'm Sam Hodges. I co-founded and run the U.S. business for Funding Circle. I've been doing this for about the past 4 years. And I think many of the listeners probably know Funding Circle is the world's leading marketplace lender focused on small business loans. So since we got founded, have lent out about $1 billion to great small businesses across the U.S. and the U.K.
Okay, so let's just give the listeners a bit of a background about how Funding Circle USA actually came to be. I know when we first met, you were endurance lending. So just explain how you morphed from endurance lending to Funding Circle USA.
Okay. So my co-founder and I in the U.S. had originally started a business called Endurance Lending Network. The reason we started that company is actually very much based on our experience as small business owners ourselves. Both of us had worked in a variety of different traditional finance and technology roles, but then had the experience of building up a successful network of fitness businesses all across the country, gyms that actually still exist today. But the kind of crazy thing was, despite the traction we had in that business, it was really hard to get a loan. And the more we kind of scratched that problem, the more we realized there's really a structural gap between where banks kind of leave off and where other lenders play. And what that means is there are a whole category of small businesses who are underserved. So we started Endurance Lending Network in I guess, the summer of 2011, built it up organically from then until summer of 2013. And during that period of time, had gotten to know the folks at Funding Circle really well, Samir, Andrew, and James being the three main founders over there. And long story short, saw a lot of kind of strategic fit between the two businesses. And so that summer of 2013, we decided to put the businesses together and have been operating under the Funding Circle name since then. The great news is, of the folks we had in Endurance when we combined the companies, the vast majority are still with us today. So overall, it's been a very successful business combination.
Yes, I imagine so. So those gyms that you started, did you sell that company, or is it you obviously didn't put any more effort into it? I imagine once this took off.
Indeed, yeah. No, I certainly don't have time to do it day to day. But the good news is, one of my partners in that business is able to run it day to day, and so they still exist. They're still going. Still quite successful and actually expanding, which is great to see.
Cool. And I guess that they know where to go if they want a loan, right?
That they do.
So just talk about your loans a bit. These are term loans. You don't deal with the short-term kind of loans at all. Tell us about sort of the range of interest rates and typical loan amounts and that sort of thing.
Perfect. So our focus is on delivering a loan that solves the problem we had as small business owners, which is the need for expansion capital. There are lots of different solutions out there if you need a very short-term, smaller dollar, high-rate loan. But if what you really need is the type of loan that banks did 20 or 30 years ago, there aren't all that many options out there. So a Funding Circle loan is a loan that's priced between 6 and about 21%. It's an amortizing term loan where the payments are spread out over 1 to 5 years. These loans are fully secured. both by the assets in the business and then also a personal guarantee. And so what it means is for the best borrowers, the ones who are the most creditworthy and with traction, they're getting a very fairly priced and very low-rate loan, one that's directly comparable to what they might be able to get from a bank. But we also have loans for businesses that perhaps have had, a bit more challenges, or simply they're just businesses that are a bit earlier on in their trajectory, and therefore, where there's a bit more risk.
Okay, so then, so you do like 1 up to 5. Is the average around 3 years? I mean, what's the?
That's right. Yeah, no, the average term is about 3 years. And, the typical use of funds, I should say the average loan size is about $125,000.
Okay.
And the typical use of funds is for a business who's looking to do something like expand a storefront or open a new location or buy equipment and hire employees in advance of being able to grow. So, kind of broad uses of different funds, but really geared very much around expansion.
Okay, and so these, like when you talk about small business, there's obviously a huge variety of companies out there. Do you have? Can you tell us some of the verticals you're in, and if you have a focus on one or more, on a couple of specific niches?
We have a really diversified set of small businesses who we've been able to serve. Ranging from a multi-unit salad company in San Francisco to a healthcare services business in suburban Atlanta, to a logistics company in the Midwest. Our borrowers really represent the full range of great small businesses that are present across the country. We've made loans in all 50 states. We do operate the platform very nationally, and no one category of borrowers, takes up more than about 15% or so of our overall book. And so, really, what we look for in terms of the types of businesses we lend to are ones with strong cash flow, strong revenue traction and growth, and a viable need around how they use, again, expansion capital.
Are you still doing? I know when you started off, you really focused on the franchise market. Is that still a good market for you guys?
Franchise market remains a really interesting market for us. We established about 40 different franchise partnerships. Partnerships with names like Papa John's, where if you're an established franchisee looking to expand, we actually are a preferred lender to many of those networks. So definitely it's a category we still really like. That being said, at this point, it accounts for a minority of the origination that we do, simply because we've seen kind of a broad base of opportunity beyond the franchise space, and we've been able to grow the business and now, again, can serve a wide diversity of small businesses.
Right. So, and where do you find the borrowers? I know you've got salespeople on staff. Do you work with brokers a lot as well? I mean, what are the main channels that you find where you find these small business owners looking to borrow money?
Absolutely. So, I guess the short answer is it's really diversified set of acquisition channels through which we find small business borrowers. On the direct marketing side, we do a lot of direct mail. We also do a lot of digital advertising, PPC, social, and also affiliate. And then on the full partner side, or kind of the intermediated acquisition, we have a pretty broad base of referral partners, certainly including loan brokers, SBA loan brokers particularly, equipment finance brokers, but then also businesses like accountancies, regional accountancies, or kind of sole practice certified public accountants who are sending us their small business customers when those customers need financing.
Okay. So then, I was in your office again just recently, and I was in like 6 months ago, and you're growing tremendously, just like a lot of the other companies in this industry. But can you give the listeners some idea about what's your US loan volume right now?
Sure. So in the US, we're lending out about $15 million a month, and that number is one that's growing quite quickly. Call it north of 10% month over month. Okay,
and then. On one of the things that the UK company has done, and I keep wondering when you guys are going to do it, is giving the loan history and the data over to investors. Is that on your roadmap, and if so, when?
Short answer is it is. I mean, one of the foundational principles of how we operate the marketplace is transparency. Transparency with the borrowers around what type of loan product they're getting, and also transparency with investors around how historical returns have played out, and also as much transparency as we can offer in terms of what they're actually investing in. So in the U.S., frankly, the constraint is at this point pretty much just technical, which is we're trying to get the ability to calculate real-time portfolio returns and automate that so we don't have to have too many employees just kind of doing the data management to keep our records up to date. The worst thing would be if we furnished data, but then those data went stale. So, providing real-time available information on the historical portfolio absolutely is part of the plan, and we're going to do it, frankly, as soon as we have the product capacity to do that.
Okay, so investors coming onto your platform today, what sort of data do you provide? I mean, I presume you have some large investors that would demand, obviously, your complete loan book. Is that so? That is something that you're providing to investors today?
Correct. Yep.
Yeah,
that is correct. Yeah, we provide the loan book to investors, and we provide historical returns as of a point in time. What we're waiting on is just the ability to offer it in complete real time up through wherever you stand today. Okay,
fair enough. So you guys released the fractional marketplace a few months ago. It's so for the first time people can invest in true small business loans on a fractional basis. But can you just describe for the listeners how that fractional marketplace works, how it's similar to Lending Club and Prosper, and how it's different?
Sure. So we launched our fractional marketplace because we thought that this investment product, the ability to invest in small business loans, would be a great one for a pretty wide range of different accredited and institutional investors. And as opposed to our whole loan marketplace, which is dominated by institutions, of course, because of just the investment sizes, the fractional marketplace allows investors to put as little as $1,000 into any particular loan. And so what we've seen is actually a really strong base of interest, despite the fact that we're really just starting to gear up our marketing efforts, where hundreds of accredited investors have come and signed up and gone through our accreditation process and are now actively investing in those loans through us. So if you're an accredited investor and you're looking for a great, new kind of alternative fixed income product, we certainly encourage folks to check it out. Now, this product is, in many ways similar to what you can get through Prosper and Lending Club. The two big differences, of course, are number one, as opposed to investing in unsecured consumer loans, which is the majority of what those platforms do. In our case, this is the ability to invest in secured business loans. That's different in terms of the underlying asset. And then the other big difference is, unfortunately, at this point, we have to keep it limited to accredited investors. So folks do need to meet certain either minimum net worth or minimum income standards in order for us to be able to sell them this security product.
Okay, so let's just go back to that secured loans that you just mentioned there. How are you actually providing that for investors? Are you securing? You require hard assets? Do you require personal guarantee? How are you actually securing the loan?
So every single loan we've done in the U.S. has two layers of security. The first is a security filing or a UCC filing on the business assets themselves, and the second line of defense is a personal guarantee. And so what that means is, if one of these loans is going to go bad, it means the business has to fail. The individual needs to basically decide not to pay us back out of whatever the assets are, and they also would need to choose to not pay out of their own personal pocket, rather, to the extent that it went that far. And this, if you think about the way this is structured, it's actually quite typical to how a commercial bank would structure a loan product for one of their borrowers. And because these loans are secured this way, that's what allows us to offer, in effect, a cost of loan or an interest rate to the borrower that's very attractive and fair, while at the same time also being able to offer, what should be very stable returns to our investors.
Mm-hmm. Okay, so let's just let's talk about that a little bit. What I saw some, I don't know whether a press release or what it was, but came out. I've seen a couple of articles that are talking about your returns to date. Can you tell listeners what the average returns have been now? You've been operating obviously for a few years now. So what are you providing?
Sure. So our investor returns on the marketplace, if you take the overall portfolio in the U.S. over the trailing 12 months, they've been north of 10%. Now, obviously, the actual realized returns depend on which exact loans you hold and how diversified your portfolio is. But based on where we're pricing these loans and based on some reasonable level of diversification, we do expect many investors to be able to get returns at that order, which, of course, relative to other investment products that are out there, we think is quite attractive.
Okay, and so then what about defaults? And you're doing quite a few loans. You must have seen at least, if not defaults, then loans that have gone into arrears. How has that been going for you guys? Is it meeting your expectations, and where are you at?
Sure. So our overall loss levels are broadly in line with what we projected. They came in a little bit higher for the first half of 2014 than we expected. But, starting with the second half of 2014 and certainly this year to date, they've been broadly in line with what our projections were. Our delinquency rate and default rate of our current portfolio also is very much in line. So you're talking about an annualized loss level, in the low single digits, which again, given where these loans are priced, that leads to attractive returns, provided one's portfolio is sufficiently diversified.
Mm-hmm. So when you're talking about losses there, you've taken security interest in the business. Is that expected losses, actual losses when you talk about low single digits? And are you able to kind of get back some of the assets from the businesses that are struggling?
Yes, and in the case of loans that actually have gone into full default and workout, we have experienced and do expect to experience some level of recovery. In the UK, for example, where we've got about 2 years of additional recovery data, but where, frankly, we expect the U.S. portfolio to perform somewhat similarly, our recovery rates have been on the order of 30 or 40%, so quite attractive. And what that means is if you just think through kind of the delinquency and default math, but then also impute that recovery rate, that's also very supportive of attractive risk-adjusted returns.
Right. Okay. So then when someone's coming to sign up to your fractional marketplace, what are you providing for the investors? Obviously, this is not anonymous, I presume, or how, what are you doing to make investors comfortable that they understand and they can make a good judgment based on the risk?
Yeah. So what we provide to investors who are investing in the fractional marketplace is a sufficient level of financial granularity and kind of general characteristics of the business itself for them to make a very informed decision as to that type of loan. Now, the reality has been actually that most investors are choosing to programmatically invest or do things like put money into our fund product. And I think the reason they do that is they're really buying into the theme of diversification, and what they're looking to do is try to get exposure to as many small business loans as they possibly can, or at least as many small business loans of type X as they possibly can. And again, given that credit risk is somewhat idiosyncratic, that's certainly something that we encourage.
Right. So on the fractional side, you are not providing the company name. Is that correct?
That is correct.
Okay. But on the whole loan side, are you doing so?
We have to be very careful about what information we offer through, because just from an FCA perspective, from a compliance perspective, right, you can't commingle personally identifiable information
right
with a lot of the credit and financial information that investors use to make their investment decisions. So generally speaking, just in order to be compliant with our regulatory standards, we do need to be very careful about information like that.
Right. Fair enough. And so then people can still invest in your fund today as well as the fractional?
That's right. So we rolled out what we call the Funding Circle Diversified Income Fund about the same time that we launched the fractional marketplace. And that's a product for primarily high net worth individuals and family offices. It's got a higher kind of investment minimum, but it's a way for them to get programmatic diversification and also the kind of pass-through benefits of holding a fund structure.
So is that fund only investing in whole loans, or is it going to invest in the fractional as well?
That fund is only investing in fractional.
Okay. So then if that was my next question, like if someone's on the fractional marketplace and you see the loan is 50% filled, does the fund come in then and fill it? I mean, and are all the loans being funded on the fractional?
So any loan that we list on fractional, we have sufficient liquidity to, not completely, but to in effect guarantee that they get filled out. That being said, we're not using the fund to fill out a loan, right? Because potentially that could lead to adverse selection for the fund. So rather, what the fund does is programmatically take a minority piece of every single fractional loan.
Okay.
And then individual investors who are, up on the marketplace are basically filling out the rest.
Okay, so you sort of see how much demand, what the available cash is in all the investors' accounts, and you think, okay, well, And you obviously, for the programmatical ones, you know exactly what their criteria is, I guess. So you can make a pretty good judgment call as to whether or not it's going to be filled.
That's correct. So we have, of course, don't want to send loans to the fractional marketplace if there aren't enough people there to invest in them. And so we keep a very close, watch on how much investor appetite there is. And what we try to do is send out the right number of loans so people can quickly diversify and build a diverse portfolio, while at the same time making sure that the loans don't break.
Right. Okay. Fair enough. Okay. I want to switch gears a little bit and talk about regulation. And we were both on the panel in front of the Small Business Committee in Washington D.C. a couple of weeks ago. And just before, I just wanted to get your thoughts on how you thought that the whole that testimony went and the attitudes of the members of the committee.
So we were very honored to be asked to participate on the panel, and felt really good about the fact that the House Small Business Committee is obviously taking marketplace or peer-to-peer lending very seriously as a way for small businesses to get access to the capital they need to expand and grow. I thought that the members' questions overall were very well informed, and I think spoke to they're very balanced, right? They spoke both to the real value and potential that this approach has in terms of meeting those small businesses' capital needs, while at the same time, also was sensitive to potential conflicts or concerns. If these models weren't developed in a really mature way. After the panel, I had a chance to connect with a number of the members kind of one-on-one, and what we felt at least was a very high degree of enthusiasm around the potential here, again, provided we and the other platforms who are kind of developing the sector do so in a responsible way.
Mm-hmm. Yeah, I felt that too. I felt like there was sort of some restrained enthusiasm, shall we say, from some of the politicians there. It was good that they are wanting to learn more. So what I'd like to do is just, if you could explain now, in less than 10 minutes, the regulatory framework that you operate now on both the borrower and the investor side. What federal and state licenses and laws are in play for Funding Circle?
Sure thing. So on the borrower side, or on the side on which we make loans, we're regulated primarily by the states, but also have to be compliant with federal lending statutes, particularly Equal Credit Opportunity Act and the Fair Credit Reporting Act. But most of the licensure we need and most of the parameters we follow in terms of making loans, again, is a state issue or kind of question. And so what we've done is put together a regulatory framework that allows us to operate nationally. Which is something we're very proud of and took quite a bit of work to achieve, but we think is just really the right way of going about it, so that this business is set up properly. On the other side, on the capital formation side, it depends on whether you're speaking of our whole loan marketplace or the fractional marketplace. The whole loan marketplace isn't a securities business. It's just considered a type of commercial lending activity where we originate the loan and then in effect sell that loan through to a whole loan investor who's interested in purchasing it. The fractional marketplace is a securities offering, or is in effect structured as a securities offering. We use a broker-dealer to manage the fractionalization and the sale of those securities. So we have a broker-dealer, we have licensed staff. That broker-dealer is a FINRA member, and by extension, the SEC is the primary federal regulator that we need to kind of make sure we're on the good side of. In addition to that, of course, with any securities offering, there are also state-level laws or what are called blue sky laws that govern exactly how you manage an offering, what disclosures you need to do, what filings you need to do, and so forth.
Okay, so then on both sides of the marketplace, then are you available to all 50 states?
We are, although on the investor side, it's a bit more challenging because some states are very onerous in terms of what you need to do in order to market an offering. So what I'd say is conceptually that's the case, but practically speaking, there are certain states that are a bit more challenging than others.
Right, because you're not doing general solicitation. Is that correct?
No, we are doing general solicitation. So we're doing what's considered a Reg D private offering under Rule 506C. So we are generally soliciting, and then we're just very carefully going through and actually accrediting any investor who wants to participate. So that's kind of the burden of proof on us as the broker-dealer manager and in effect the people who are managing the issuance of those securities.
Okay, so some states don't even like, you're doing general solicitation, and some states still have issues with like approaching accredited investors. Is that what you're saying?
I guess that's the short of it. And even beyond the solicitation piece, the other trick is any securities filings you need to do. So, if you wanted to go in more detail, I guess I could get folks on our legal team on the call. But the short of it is, because there's that overlapping regulatory framework with some federal securities rules, but then also a set of state-level securities rules, you just need to be very careful, not only about how you market securities offering, also how you do the accreditation, and then also how you do disclosure and any filings in state associated with that securities offering.
Right. But on the borrower side, you don't like if you're a consumer lending business, most of the consumer lenders partner with a bank to actually originate the loan. But on the small business side, it sounds like you guys are originating the loan directly. Is that correct? You're not partnering with a bank.
That's correct. And so in states where we need to be licensed, we are licensed or in the process of being licensed, I should say. The point being, we stay within the kind of statutory requirements in state in order to be set up as a commercial lender. In some states, you're allowed to make up to X number of loans before having to become licensed. And those are the states where, we're just now going through that process as we ramp up our lending activities. In states like California, where we got started, we are a licensed lender. We actually have 2 California finance lending licenses, one to support our whole loan business and the other to support our fractional marketplace.
Okay.
But I guess that aside, the kind of short answer to the question is, yes, we are kind of doing the lending directly under our own licensees. And I think one big difference between consumer lending and commercial lending is the state-level lending rules are just sufficiently different that you can, as a national lender, kind of go state by state, provided that you stay under state-level usury caps. And one of the advantages that we have, given the part of the market we're playing, is our loans are priced pretty fairly, like I said, and in a fashion that in general is under usury caps. Right. So in certain states that have lower usury caps, we may not be able to offer a particular risk tier, and that's of course fine in order to be compliant. But in most states, we've got a lot of freedom to operate.
Right. Okay. So, at our hearing a couple of weeks ago, we had in the audience, I'm sure you chatted with them. There was the regulatory affairs people from Lending Club and On Deck. They were both in attendance. What's your approach to dealing with Washington D.C.? Are you going to take a proactive approach, kind of like those 2 companies?
Yeah, our plan is to take a very proactive, engaged stance vis-a-vis our regulators and any potential regulator, both at a state and federal level. We think it's really important, just as we're very transparent with our borrowers and with our investors, that we're also, frankly, transparent with our regulators. In many corners of the small business lending market, we do see practices that we think are borderline abusive, and they certainly concern us. And it's important that we and other responsible lenders kind of band together and, at the very least, engage in pretty good self-regulation, so that we can draw a very clear line between what we're doing and what other perhaps less scrupulous folks are doing in their activities.
Right. Okay. And so I know you mentioned that a couple of times in your testimony. The self-regulatory piece seems like it's pretty important to you guys. Is that, what more can you say about it as far as dealing, actually creating something that, whether it's some sort of trade body or something that is formalized in that approach?
Yeah. Well, these conversations are still in early days, so not yet in a place where we can say anything too formally. But I guess what I'd say is we've been talking to a number of other platforms who are, also getting to scale and who also care a lot about the future of the industry, and who I do think are thinking about this in a pretty long-term way. And what we collectively are trying to do is figure out a framework that lays out how we want to operate these businesses, particularly things like disclosure standards around the price of credit, certain standards around how we work with intermediaries and other folks who might market on our behalf. Those are standards that I think are going to be really important as, marketplace lending becomes an ever-increasing source of financing for small business.
Mm-hmm, mm-hmm. Okay, fair enough. So then today you're, you guys are growing fast. I mean, where are you finding it more challenging to grow? Is it sort of finding on the investor side or the borrower side, or are they both in perfect balance right now?
well, as you probably know from long experience in the space, you're never quite in perfect balance.
Right.
But I guess what I'd say is we continue to see really strong appetite on both sides. If anything, just given a couple of very large institutional lending deals we've struck recently, as well as the success of our fractional marketplace, we are slightly more borrower constrained than capital constrained, and so we're very focused on ramping up our direct acquisition efforts as well as solidifying great partners through whom we can find small businesses.
So do you find when you're trying to ramp up your borrow efforts, are you coming across, like if you lose a loan, obviously you're not going to gain every single prospect that comes in the door. Are you losing it to a traditional lender, or are you finding more and more that there's other online lenders that are in the game that are trying to undercut you or what have you?
No, typically when we lose a borrower, actually the reason is the borrower has chosen not to move forward with financing, or they've gotten a loan from a bank at an extremely low level. So, for example, if a small business has had the chance to go through kind of an SBA process, they've been at it for a couple of months, and they've got a great relationship with a commercial bank, and they're able to get a term loan at 4.5% or 5%. We encourage those small businesses to take that loan, because right now even our lowest rates aren't quite competitive with that, even though on the whole we're very competitive with where most bank loans come out.
Right.
When we lose business to other kind of non-bank lenders, I guess what I'd say is typically it's just because of the difference of view on risk. We do see a couple of players occasionally taking on loans with pricing that we don't think makes sense, but everyone has a slightly different risk model, and so I'm sure they would probably say the same thing about us on the margin. In terms of new entrants in the space, I wouldn't say over the last couple of years we've seen anyone particularly new come in and surprise us at all. There are a handful of other marketplace lenders who certainly are active, and we bump into them, particularly in our intermediated channels. But with direct acquisition, the good news is typically these folks hadn't ever heard of marketplace lending or peer-to-peer lending, and so we just need to educate them on what we do and show them how it can be potentially a very good fit for their capital needs.
Right. Okay, so before I let you go, one last question. Obviously, your goals are to get bigger and more and get more volume going. But what else are you looking for Funding Circle to do in the next year or two?
So there are three kind of major growth themes. The first of which is just driving scale, which is really around ramping up our marketing efforts, improving our operational efficiency so that we can create capacity and further automating, many areas of the business. The second major theme is around product breadth. So right now we do, basically A+ through what we call C risk tiers. But beyond that, I think there's an ability to, do safer loans and also potentially move up the risk spectrum a little bit so that we can serve an even higher share of the small businesses in need of credit. Beyond just credit tiers, though, there are also different amortization structures and different loan product types that we see a lot of appetite for. For example, there may be an appetite for unsecured kind of shorter-term loans. We see some appetite for equipment finance. We've seen appetite for line of credit type products, and we're in the process of exploring what we want to do next as we widen the range of loans that we can do. And then the third major theme is geographic expansion. As you know, Funding Circle is very active in the U.S. and the UK, but we see opportunity across a lot of other small business markets all over the world. And so even as, my day-to-day focus, of course, remains 100% on making sure that our operations in the U.S. scale and we serve, as many small businesses as we possibly can. I have colleagues in the UK who are also thinking about where we can take this model next.
So you're not going to give us a clue on what countries are in the running? Is there a Funding Circle China in the offering sometime soon?
I don't think China will be next. We do see a lot of opportunity in Western Europe. Spain, Italy, and France are all markets that seem to have the structural preconditions to potentially do what we do and potentially serve a lot of great small businesses and also get a wide range of investors involved. Nothing to announce or kind of no further direction I can give at this point, but it is something we're starting to look at more seriously.
Okay. Well, on that note, I'd like to thank you very much, Sam, for coming on the show.
Peter, always a pleasure. Thank you.
Okay. Cheers. Bye. One of the things that fascinates me about the small business lending market, particularly when it comes to the online space, is that it's pretty wide open right now. I mean, you've got OnDeck, who were the first to go public, and they're certainly the largest online small business lender today, but they're focusing in a different area than Funding Circle. I'm sure there's a little overlap, but for the most part, they operate in completely different spaces. And as far as the term loan products, these 3 and 4 and 5 year loans, there's no one that's really dominating in this country doing those kinds of loans. And, it's the banks that have really dominated, and, they don't like doing the smaller loans, and they're losing customers to these online marketplaces. So a company like Funding Circle could very much become, the leading brand in this country and for elsewhere for that matter around the world, because small business lending seems to be in high demand in many countries, not just in the US. Anyway, on that note, I'd sign off. Before I do, though, just one request. If you've been listening to the show for a while, I certainly appreciate that. I would appreciate it even more if you would go to iTunes or Stitcher, wherever you're listening to this show, and give the Lend Academy podcast an honest review. And I would really appreciate that. And on that note, I will catch you next time. Bye.